Jim, welcome back to Real Vision.
Thanks for having me.
It's a pleasure to have you here, this time on the Real Vision crypto side. Jim, you've been in this space literally for decades. People who are on the macro side, on the capital market side, will already know who you are and what you do. But for folks on the crypto side who may not be familiar, tell us a little bit about your work.
Yeah, so I am a macro strategist, maybe even an economist, although I don't consider myself one, but I do a lot of that kind of work. And I've been operating in this space since the 1990s. So I've been producing research for our institutional client base in economics, in strategy, a little bit in politics, some technical analysis, trying to give insight and edges on where the big picture is going in stocks, in bonds, in currencies, in Federal Reserve policy, and the like. So I've been like I said, I've been doing this since the 90s, and I've been all over the lot with terms of where I go. Because I run my own firm, I'm allowed that flexibility to kind of go where I think the story is. Whereas Wall Street tends to take strategists like me and silo you into, you are the emerging market strategist, or you are the developed market economist, and you can't really go outside of that silo. I go outside those silos all the time.
Yeah. And that actually lends itself directly to the next question, which is, you and I have both been doing this for a long time. We've both been watching markets for a long time. There are a lot of people who just don't get the digital asset space. I mean, smart people on the capital market side who write books about how markets function. Either they are overtly hostile to it, or more often say things like, well, I just don't get it yet. Maybe this is going to go away tomorrow. I'm not really that interested. What was it that led to your key insights to realize that this space was something that was important?
So I started trading in this space back in 2017. I opened up a GDAX account, which is now Coinbase Pro, and I started playing around with Bitcoin and a little bit of Ethereum. And to be honest with you, back in that time, I found it interesting, but I didn't really see a use case for it. I thought I was betting on magic beans going up and down and was just having some fun doing it. But as I kept pace with the space during the crypto winter of 2018 and 2019, I saw the rise of DeFi come. And then when DeFi summer hit last year, it started to become into focus to me. Here's the use case for all of this. This is a parallel financial system that is being built. It is version 1.0 of that new system. It is still the Wild West. And there was another rug pull this morning, as we talk right now. And there's going to be more innovation, and there's going to be more changes in this space. But if you can look past the immediate issues in the space, gas fees and Ethereum, for example, down the road, once ETH2 comes, once a lot of these other protocols have gone through a couple of upgrades as well, too, you could see where we're going with this. And it is a whole new financial system that is being built right now.
Yeah, I should probably say we're recording here on Monday, May 17th, set to air on Friday, May 21st. So there's been some volatility, obviously, over the weekend. Today, talk a little bit about that, how you think about it in the context of the bigger picture.
Yeah, well, I mean, the immediate volatility over the weekend is always from the center of the volatility universe, otherwise known as Elon Musk, and his tweets over the weekend about Bitcoin and energy usage and Dogecoin, and it's got everybody all worked up as well, too. So, but as far as volatility goes in general, this is part of an emerging technology. Those in the traditional financial space should be comfortable with this idea. You invest in pharma startups with zero revenue, but a bunch of guys with lab coats and high degrees that you're betting will do something special, like a Moderna did with the vaccine. So, and those types of companies boom and bust all the time. Look at some of the technology companies that have become old staples. Apple has had 7 corrections of at least 80% in its history. 7. In fact, between 1983 and 2003, for 20 years, the stock price did nothing. It went sideways for 20 years. Amazon had a 93% correction. It went from $100 in 1999 to $6 in 2001. So you should understand that when you get these new technologies, you get this kind of incredible volatility. It's par for the course because everything is so uncertain about it. And also, what happens too is you need to separate the protocol from the specific, or I'm sorry, the concept from the protocol. And what do I mean by that? DeFi I think is going to be a new parallel financial system, and it's going to replace the old financial system. Okay, great. So I should go buy the Uniswap token. Well, maybe that is going to be the winner, or maybe it's not going to be the winner. We'll have to see. The example I've used is, let's say it's 1998, and you come to the conclusion e-commerce is going to be the biggest thing ever. And I think I'm going to play on pet supplies, and I'm going to buy pets.com. Went to zero. You lost 100% of your money. But fast forward 20 years later, and we have Chewy, and it's been an enormous success. So when you look at the space, I could say DeFi is going to be a winner, but am I investing in pets or am I investing in Chewy? That's going to be the trick, I think, when it comes to people deciding where they want to put their money and how they want to position themselves in this space.
Yeah. There's so many important points that you've touched on there. First, this nature of volatility in new technology, I think, is such an important point, especially from someone who has this voice, who has understood and seen and witnessed these cycles before. When you talk about the volatility in Amazon, in Apple, it gives a sense of just a bit of context for how volatility can exist in the context of a larger trend.
Sure. And you've even seen it in recent months or so. Goldman Sachs has a non-profitable technology index, and that has been extraordinarily volatile, headed up by things like Plug Power and Neo, as far as two of the bigger players in that space. But non-profitable tech tends to become profitable tech, and then they tend to settle out. The other thing you need to understand about new spaces too, and it gets to like venture capital. A lot of these will go out of business as well too. In venture capital, Roger McNamee of Elevation Partners many years ago spoke the truth once. I was watching him on CNBC, and they asked him, how do you pick your companies that you invest in? And he said, I buy them all. 80% of them go to zero, but the few that wind up making it go up 100x or 500x, and they make up for all the losses. I'm kind of paraphrasing what he said. And I feel like that's kind of the same way with this space as well too. The space itself, I think, will live on. Most of these protocols will go out of business, but the few that don't will go up tremendously and become transformational.